topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio, its employees, or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome and good morning. It's a great Monday morning, and it's great to be here talking taxes, bookkeeping, financials, tax planning, everything that you need, not just personally for your personal life and your personal taxes, but also business and business taxes, and things you can do to save money. And today, we're talking about tax planning. People go, well, why? Why do we do tax planning? Well, tax planning helps you save money. And, if you go back to, we kind of talked the other week about the federal tax code and that, federal tax code started in 1913. And today that tax code is 187 times longer than it was, more than a century ago. And, you start dealing with things like that. You start dealing with tax code that is there to you to use as your advantage, your tool. I mean, you think about it. Tax code is 6,871 pages long, and then you add to that all the official guidance that the IRS and the U.S. Department of Treasury puts on you, and now it's over 75,000 pages and extremely complicated. Now, do you think in those 75,000 pages there isn't ways to lower your taxes? There isn't ways to save money on your taxes? The one thing that I would tell you is go read it. If you want to know everything yourself, go read it. It's going to take you roughly 14 weeks to read that code. And that's saying you can stay awake while you're reading it and then understand what you're reading as well. And that's why having a good tax person is invaluable to you, to your business, to developing the strategies that's going to save you money. Now, I talk about taxes and bookkeeping at many programs around the country, and it's particularly I do this great event coming up later this month. It's October 21st through the 23rd. It's in Blue Springs, Missouri. It's called Truck to Success. So, if you're a trucker, and maybe you're a W-2 trucker and you're looking out to come out to become an owner or operator. Maybe you're an owner or operator thinking, hey, I don't want to be leased on anymore. I want my own authority and I want to do things. Truck to Success is the place to be. Now, I'm going to talk a little bit more in a later section. So if you do know a trucker, W-2 driver, owner or operator that's looking to do those things, hey, call them now. Tell them to tune into Tax Talk for You. Right here in W4CY.com, W4CY Radio, and have them listen in, because we're going to talk a little bit about Truck to Success here later on in this program. So give a call to them and give a shout out so that they can hear a little bit about this, and maybe they can gain some knowledge that, hey, they need to be at Truck to Success. But one of the things that we look at when I'm talking at these different programs, we talk about the most expensive mistakes that cost business owners thousands of dollars every year. And you know what that biggest mistake is? It's the failure to plan. You've got to have a plan. Now, we're not just talking about a business plan. We're talking about tax plans. One of my favorite lines was said by William H. Rehnquist, Chief Justice of the Supreme Court. And he said, there is nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. Now, that came from a former Chief Justice of the Supreme Court. Now, what does the Internal Revenue Code actually do? It provides the roadmap to avoid the payment of taxes. Yes, it mandates you have to file a tax return. Yes, it mandates here's what's reportable, but it gives you the roadmap on how you can get around taxes. How do you maneuver in your business, in your life, to avoid the payment of taxes, minimize your tax burden? Why tax planning? Because it's the key to your financial defense. Also, if you're doing tax planning, it's going to guarantee results. That's right. What results does it guarantee? If you are planning and doing strategies to avoid payment of taxes legally, the results are guaranteed to save you money on your taxes. That's right. Gives you guarantee. We're talking about not just income taxes, but we're also talking self-employment taxes. So when you are employed, you're just dealing with W-2 taxes, and you're going to use every plan that you have out there. Now, when you're self-employed, you're also trying to avoid not just the income tax side of it, but you want to avoid the self-employment tax, Social Security, Medicare. That adds 15.3% right there to your taxes automatically from your bottom line from your business. So it becomes really, really important to do that. We start talking about self-employment taxes. It has a couple of components to it. It's Social Security. And for 2025, you're taxed to $176,100 of your combined wages, tips, net earnings. So that's at 12.4%. Now, 2026 projected your wage base is going to go all the way up to $183,600. So it becomes very, very important. Now you add to that the Medicare tax. So there's no wage base limit on that, and it's 2.9% of all your self-employment taxes. Becomes expensive. And then, because you're not taxed enough, if you're married filing joint over $250,000, single over $200,000, or married filing separate over $125,000, you get another 0.9% Medicare tax if your wages, compensation, self-employment income together with your spouse, if you're filing joint, exceed those thresholds. So, when you start thinking about how we're going to start planning for what we're doing, it has to start with, especially if you're in business, how do you reduce your self-employment income to get that income down? Because where you are in business, especially when you're self-employed, is going to dictate how much money you're going to pay in taxes. Now, you got to use the tax code to your strategy the best possible way. Now, I always say, what you're doing is you're looking at your income, and then you start your planning and you start figuring out where you want to go. And one of the big things you got to start looking at is, how are you classifying the money that you're spending? Is it business expenses? And if you're missing business expenses, or you're paying expenses for your business out of your personal and you're not taking the deduction, you're losing. Because you lose every time you spend after-tax dollars that could have been pre-tax. So you want to move the money that you're spending today for your business and making sure you're getting every deduction possible. You're finding every business expense that should be written off in your business to lower that business income, to reduce your self-employment taxes, Social Security, Medicare, and then also reduce on top of that your federal income tax. Savings, savings, savings. That's what it comes down to, is how do you maximize those deductions from your gross income to reduce your net income, to reduce your Social Security, Medicare, self-employment taxes, federal income taxes, state income taxes, if you're in a state also that has income tax, from there. So, I suggest making sure you've got a good bookkeeper, you've got a good tax preparer, and you're making sure you're maximizing your deductions. Now, we're going to take a quick break here. We're going to come back and we're going to talk more about keys to cutting your taxes through tax planning. We'll do that right after this.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. We're talking about keys to cutting your taxes, tax planning, both business and personal. A lot of this is going to be focused around business, but we're also going to talk about personal things that you can do in your personal life to lower those income taxes down as well. The goal isn't getting the biggest refund. You think that's fun, but realistically, all you've done is loan money interest-free to the federal government. And so, if you're using tax planning and you're using strategies to lower your income taxes down, then you can also adjust your withholdings as well and file, the new W-4 and lower the amount they're going to withhold, because it's about keeping more money in your pocket, more money that you can save and invest, that you can earn interest on or make money off of through investments or whatever you want to do. It's not about loaning the government money so you get a big refund, because it's not the government giving you money, it's giving back your money. And so we don't want to do that. Tax planning, this is what this is all about, saving you money on your taxes. Because, remember, and I ingrain this into people's heads, that if you're in business, you lose every time you spend after-tax dollars that could have been pre-tax. And some of that is true, as a individual. If you have plans available to you through the companies you work for, They put money into maybe an HSA, 401ks, flexible spending arrangements, maybe childcare spending where they can pull that money out pre-tax, and then you can't do it. I have to laugh, and I talk about reading tax code, but I also talk about reading other documents when you're in business. Before you sign something, you read. And same with your personal life. My father ingrained in me that you never sign anything that you haven't read. And then it goes with your tax return. If you have somebody preparing your tax return, go through it and read it, look at it, make sure the numbers are correct, because you are signing it under penalties of perjury. And, we want to make sure that you have the opportunity to review the taxes that you have. So yes, we read the tax code, and we read the changes that are done, including the changes in the 900 pages that was in the one big, beautiful bill. And then we make plans for our clients to make this work. Now, amazingly enough, some politicians have never read the complete code. Some politicians never met a tax that they didn't like. And many politicians just vote because somebody in their office and staff that read it said, yes, you should vote for this. Does it make it right? No. When we talk to people and we hear, you hear celebrities and other people out there, everyone is always good when the tax is on someone else. However, when you now reach that income level that you thought it was okay to be taxed more on, you're going, what? I didn't vote for this. Yes, you did. Vote for more tax, and you get there, you have to pay that more tax. Most celebrities are good at discussing taxes and increases, but don't really want to pay more than themselves. That's why they do tax planning. Realistically, anybody that had the money that wanted to spend and pay more money into the federal government, they could just write a check and not increase taxes. They could go and pay part of the deficit down. Love to see them do it, because it would help your kids, my grandkids, your grandkids, and the future generations if we would pay this debt off from the federal government. But every politician, every celebrity, every rich person, every smart person, they all have a tax plan. They all plan to figure out how to lower those taxes down. Now, in tax planning, we're looking at the opportunities that came up to us in the one big, beautiful bill. The one big, beautiful bill that President Trump signed July 4th, 2025, how fitting, had a wide range of provisions that helped nearly every single taxpayer, including individuals, corporations, pass-through entities, tax-exempt organizations. And one of the biggest benefits was the Trump tax cuts were made permanent. We weren't going to get back to going back to the old law. So that meant, standard deduction is going to remain high. Yes, I don't get to take my mortgage interest and my charitable contributions and my real estate taxes. And there may have been some limits on some of these things, but that standard deduction was really, really high. So that's really nice. They added in the senior deduction. Hey, it doesn't matter whether you're taking Social Security or not. If you're age 65 before the end of the year, you get a $6,000 deduction for each individual. So if you're married and you're both over 65, you both get a $6,000 deduction. And it doesn't matter whether you're already taking Social Security or not. Now, they do have phase outs. So again, it's, hey, we're finding a way that you're going to tax the rich. And that phase out is at 75,000 or the phase out is 150. See, tax planning, reducing that income, maybe from your business, adds another deduction if you can get that business net income down below these levels as well. Deferring some income, using tax deferred accounts, things like that can bring things down. And that's all the stuff you got to look at. Child tax credits went up to $2,200 beginning in this year, and then it's going to index with inflation. State and local tax deductions, it's gone up to $40,000, but then it phases down to $10,000 if you make over $500,000. Tax strategies got to come into play into these things, and that's using such things as depreciation. The one big beautiful bill has depreciation in here for it. They extended the bonus depreciation. The ability to elect 100% bonus depreciation under Section 168K for qualified property. I mean, it could be tractors, trailers, business equipment, computers, you name it, machinery that you may need in your business. And if it's acquired after January 19th of this year, you can take the bonus depreciation. So gives you that ability to reduce that income down. Now, what this means is that 100% bonus depreciation means you are allowed to immediately deduct the full cost of qualified property in the year it's placed into service, rather than depreciating it over its useful life. Now, there's some disadvantages to this as well, because if you're using 100% bonus depreciation, you may lose some deductions in the future that may help you. So depending on your tax situation, your tax bracket, the year the company does not buy any fixed assets, your taxes could end up being much higher. So maybe you got to look at spreading this out as well and not using bonus depreciation, how it's going to impact future planning. We're going to plan how we're going to do this. We can also use Section 179, expensing of your assets. The new law allows higher limits for the first year upfront deductions on business purchases. The bill makes Section 179 expensing permanent, doubles the maximum deduction to $2.5 million, with a phase out of $4 million in equipment purchases. And it's only applicable to property placed after taxable years after December 31, 2024. So 2025 and beyond, you're going to be able to do that. So we're using these kind of strategies to do that, and finding ways to reduce your income to the right level. Now, when we do this very smartly, whether we're using Section 179 or bonus depreciation, we're going to use it to the extent that it puts you in the right marginal tax bracket, doesn't affect future years, so that you can look at your income spread out over a period of time. Hey, when we come back, we're going to talk about how we use entities for tax planning purposes to save you money on your taxes via tax planning and reducing that income to the right level and the lowest amount allowed by law. We're going to do that right after this break.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools at 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. I hope you're enjoying this nice conversation we're having about tax planning, reducing your taxes to the lowest amount allowed by law. We're talking about, hey, where do we start? And you've got to start planning when you're in business exactly what your net income is going to be, what's projected to be, and then kind of move and go forward from there, whether you're using retirement accounts or other vehicles that you can do this. But if you're in business, one of the biggest choices you've got to make is business entity. How are you going to be set up? Now, many people start out as a DBA, sole proprietorship. Some people hear, I've got to be an LLC, a limited liability company, because that's the be all and all, because I was standing and talking to somebody else that's in business, and that's what they told me I should do. Some say, hey, I should be a corporation, S Corp, or maybe I should be a C Corp. There's a lot of choices out there, and you've got to sit down and visit with your tax preparer, your consultant, to determine which one's right. A DBA, bottom line, you're going to be taxed self-employment tax on the bottom line, federal income tax, all that's going to compound. But does it make it right to move into an LLC? Well, an LLC is going to be really no better than a DBA as far as tax goes when you're a sole member, unless you make the election to become an S Corp. But then that can get expensive for you. So where is it going to make sense? And at what level does it make sense? Well, where it makes sense is you got to look at the cost, the savings for you to be an S Corp versus a sole proprietor, the difference in the taxes and the difference in the costs. Now, as an LLC, you might be a multi-member LLC and can file a partnership return. But again, it has a cost of filing that return. So what do we discuss with our clients? We do a complete analysis with our clients to determine, hey, if you become an S Corp or a multi-member LLC, husband and wife, let's say, what's the difference in the costs? Well, if you become an S Corp, you've got to have the S Corp return done, and you've got to have payroll services. So that's going to cost you money to have those things done. So your savings when you become an S Corp really comes down to is how much am I saving via self-employment tax? So if your self-employment tax is still going to be around the same, then why be an S Corp to go through all the extra paperwork that needs to be done? Or maybe why does it have to require you to become a partnership? Because it requires additional paperwork to be done. So this is where our analysis comes in. If you set a reasonable salary, because as an S Corp or as a partnership, any business owner working within the business has to be paid what they consider to be a reasonable salary for the work they can be done. Now, what is a reasonable salary? You got to look at what work you're doing. Some of it may be administrative. Some you may be the janitor, and some may be the real high level CFO, CEO, chairman of the board, and you should be paid accordingly. Some of it may be mid-level work. You've got to analyze what you do with your day and determine what those pay rates would be to determine what a reasonable salary for you in your business should be. And then once we get from there, then we can determine, along with you, what you should be paid and how you should be paid. And that's the fun part when we get into doing that. And we get into figuring out how we're going to save you money on your taxes. Now, other things that you're going to be missing is maybe you're missing medical benefits. Healthcare costs have gone through the roof. So, maybe it's finding a way as a business entity that you can take the deduction for healthcare. So, if you're running a business and the only people working on it in the business is you, and maybe you hire your spouse, and you could give benefits to your spouse. Maybe you're running a partnership. If your spouse is less than a 5% owner in the business, hire them. You can give them benefits. If you're an S Corp and your spouse is less than 2%, then you can hire the spouse. If you're a C Corp, you can hire yourself and give medical benefits. And you could even have medical reimbursement plans. So there's really kind of cool things. Now, if you start hiring other people, your plan has to be non-discrimination and must cover all eligible employees. However, you can exclude those that are under age 25, work less than 35 hours a week, less than 9 months a year, less than 3 years of service. But if you've got multiple companies, then you're considered a control group, and you've got a whole new problem you've got to go through. But if you can do this, and talk to your tax plan, don't just jump out and do this, because you got to read the fine print of what you can do and can't do. But you could have a medical reimbursement for yourself, for your spouse, for your dependents, not subject to the 10% floor. It can avoid self-employment tax and supplements your spouse's coverage as well. So she could be working for you and qualify, and maybe she's got coverage through her other job, and you supplement. So it's a real nice thing that you can do. Eligible expenses would be stuff like major medical, long-term care, Medigap, dental, vision, chiropractic, braces, LASIK, fertility, over-the-counter medications, and a bunch of other stuff. The other thing you can be doing, and this includes if you've got a medical plan that qualifies, you can use an HSA. Even if your employer doesn't offer it, but it's a high deductible plan that qualifies for an HSA, you can do a health savings account, HSA. It gives you tax deductible savings. You can contribute up to almost $8,000 a year for family, about $4,000 for individuals. The account can continue to grow tax-free. And guess what? Tax-free withdrawals for qualified expenses. Now, this is not a use it or lose it account. It's not like some of these flexible spending arrangements that you have. You can use this to put money aside, and if you don't use it, then sorry about that. Forgot to turn my ringer off on my phone before we started this program. So we're going to do that here real quick before this person calls me back again. Another scam call though. So it's a great way to put money aside every single year. And then that account grows tax-free. Most health savings accounts, HSAs, like HSA Bank and some of the other ones, allow you to do investments. So you can invest in mutual funds and the money would grow accordingly. Again, it's another investment you kind of got to watch because you don't want to see it lose money on that as well. So you've got to take a look at these things and find ways to do it. Now, the other things that we tell people to do is we look at retirement accounts. Now, there are all kinds of different retirement accounts for you. If you're a business owner, you have multiple options. If you're an employee, most of the time, if you have retirement accounts available to you, it's your 401k. Now, I tell people, and especially new young people that come out of college, or maybe you just got out of high school and you go and you start working First thing I tell them is if your employer is matching, make sure you contribute at least every dollar they're going to match. If they're not matching, maximize what you put in anyway into your 401k that the company is offering, and then never look at it. Why do I say this? Well, because it's kind of like taxes. If you're a W-2 employee, you never feel the money that they pull out of your paycheck after the first paycheck. Yes, when you get your first paycheck, if you're like my daughter, her first paycheck that she got working her job, she looked at this and called me up, Dad, they've taken this much money out in taxes. Yes, I understand that. Why? Why so much? Well, you got to start paying into Social Security, and you've got federal withholding. Luckily, we live in a state, there's no state income tax. So you don't have to worry about that. God bless Texas. So you sit here and you say, fine. Well, after that first conversation, she never missed a dime that's going into Social Security and Medicare. She never felt it, never sees it anymore. So once you get past that first check, you start figuring out how to live within your means. So I tell people to do that. My son, he got out of school, took a job at a bank, and he was talking to me about it. I said, no, maximize your 401k. You'll never feel it. But Dad, our budget, I don't care what your budget says today. Your budget will be modified for what your take-home pay is, plus your take-home pay will be a little bit higher than you think because of some of the other savings that's involved. So you want to maximize those retirement plans. Now, that's the same thing that goes for you as a sole proprietor, a business owner. You're going to look at the different kind of retirement plans, your simple IRAs, your simplified employee pension plans, SEPs, and your 401ks. Which one's right for you? Well, each one of them has their limits, and, you have limits placed on standard IRAs, that you can put in there, each year. You have limits on your 401ks and your simplified employee pension plans. Now, haven't modified this for some of the new rules that have come out, but SEP is considered to be like a turbocharged IRA. You can contribute up to 25% of your net income from your business. Max contributions are right around $55,000. I think they've increased this one. But if you do the SEP plans and stuff, you've got to contribute for all eligible employees if you're contributing for yourself. And the contributions are directed straight to an employee's IRA type plan, but there's no administration fees. Simple IRAs in a business, you can defer up to around $12,500. Add another $3,000 if you're age 50 and above. That's including business match or profit sharing. And you contribute to an IRA. And again, no annual fees. Your 401k is the little bit more complicated one. And you're going to defer up to 100% of your income, up to $17,500. Add more if you're over 50. Your employer contributes up to 25% of covered comp, max contribution $52,000, but it does have loans, hardship withdrawals, rollovers, and it does have some simplified administration, but does have fees so that you can use retirement accounts to your advantage. Hey, I'm running over here. I've got to take a quick break, and I promised that I was going to talk about Truck to Success. I have got to get to Truck to Success. We're going to talk about you truckers and why you should go to Truck to Success, put on by OOIDA and OOIDA's Foundation. We're going to do that right after this break.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for you. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, in the short time we've got in this program, time flies when we're having fun. And, I promise to talk about OIDA, Truck to Success. And it's coming up here really soon. Deadline to register is just around the corner. If you're coming in person, you've got to sign up by October 1st. So you're just a couple of days away. They do extend the deadline if it's by Zoom to October 20th. But hey, if you are an owner operator, truck driver, or going to become one, or looking to become one, or maybe you're an owner operator and you're just looking to improve your business, then you should really consider OIDA's Truck to Success seminar. It's 3 days, October 21st to the 23rd, in Blue Springs, Missouri. It features OIDA's staff, and then other trusted experts come in and talk as well, especially like myself. I get to talk about bookkeeping, taxes, lease purchase, business entities. And this whole thing is a fantastic seminar. Having business experts available to you to talk to, and not just OIDA staff, but like me, I am there to have discussions with you outside of the classroom. Even in the evenings in the lobby, I sit and talk and allow you guys to ask whatever questions you want so that you can be better at what you do. I mean, OIDA comes in and they start talking about developing a business plan, business plans that help you start planning for success in your business. And every business should have a business plan. We talk about over 90% of businesses fail within their first year, primarily due to lack of planning. You've got to do your homework to be in business. And this is a critical first step. And go to OIDA Truck to Success, and that becomes your first step, and the step in the right direction to making sure you got the right plan. Hey, even if you spend the money and you decide you don't want to go out and become an owner operator, or you don't want to be anything but maybe leased on, at least you learned from this and prevented sometimes those mistakes. They talk about equipment and equipment financing. New trucks, used trucks. Should I finance? Should I do lease purchase, residual leases, operating leases, capital leases? How do those things work within your business? They talk about the different types of insurance that you have. Some insurances that it's required by the Federal Motor Carrier Safety Administration, and then how other insurance would work with you having maybe your own authority, or maybe if you're leased on, maybe you don't need it. They have it part of your lease. Your carrier could be responsible for having your insurance. Now, they may charge you for it. But then again, maybe you want some personal liability insurance as well. See, because kind of whoever holds that insurance is the one that has the most interest in it. So sometimes personal liability insurance goes well with whatever your carrier may be putting as well out there. And then insurance costs can vary greatly depending on where you're going, what you're hauling, things like that. So you've got to look at all that. And then own authority. There's a lot of pros and cons to operating under your own authority or leasing on to a carrier. Leasing on for a specific time is usually the best first step, is what OIDA says. And it's a good first step into becoming an owner operator. You're going to sign a lease agreement. You're going to sign on with somebody. So you're going to be a leased carrier. leased owner operator. And so you kind of want to look at those things and decide. Now, you get into your own authority, and you have to apply for that through the Department of Transportation. OIDA walks you through this. It's not complicated, but it can be very confusing. So you want to make sure you got the right advice and the right people helping you. We even talk about, safety audits and compliance reviews. They do, not me. I'm not the expert in those things. We talk about drug and alcohol consortiums and the requirements, permits, licensing, brokers, factoring. I'm totally against factoring, but some people need to use it, especially if you got your own authority and you've got to do your own collections. Sometimes using factors helps you, because they're the ones that are going to send the invoice out. They're the ones that are going to collect that invoice. Yes, they charge you a pretty exorbitant fee, but then again, so does companies like your credit card companies charge you a pretty good fee to collect and process a credit card. So if you can't afford to wait, 10 days, 30 days, 60 days, 90 days, whatever it may be that your carrier takes to pay you, factoring can be a good way of doing it. Brokers, sometimes they keep too much money. You really got to look at what you're doing and how you're doing it. But you got to do due diligence on the brokers and everything else. And then we have the most important section of the whole thing: taxes and business structure. You as an independent business person, you entered into a new tax tier. And it's kind of what we talk about. How you're going to pay taxes, your estimated taxes. If first year, how you're going to estimate your revenue and your income, what deductions are allowed and what are not. How to read a financial statement, profit and loss, the income statement, the balance sheet, why a statement of cash flows may be important. What is your cost per mile? How to use those financials to determine profitability, to determine what your company may be worth. Knowing how to depreciate your truck and when. What deductions you're going to claim as an owner operator, whether you're under your own authority or whether you're leased on. What else can you deduct? What are we looking for? What expenses? Ordinary necessary business expenses, other expenses. How do you deduct your cell phone? All these things we get to talk about and become strategically important to you in operating your business, maximizing your profit, and minimizing your taxes. See, doesn't that bring you back full circle? Tax planning. Pure and simple. We go through in Truck to Success and we talk about the tax code, how we use it to your advantage. How do you fit in each of the brackets? Where do the brackets make sense? And where are you trying to be? Tax planning for you as a business owner, as an owner operator, as a truck driver, whether you're leased on or running your own authority. Come to Truck to Success coming up. Go to OOIDA, go to Truck to Success. All you got to do is type in, search OOIDA, Truck to Success, register, and be there. Love to see you there if you're an owner operator. Hey, that's bringing us close to an end of the show. It's another great show that we've had. Next week, bring your questions. Be here, be square. But join us every Monday, 10 a.m. Eastern time at Tax Talk for You. You can go to taxtalk4you.com. Follow us over there so you never miss this episode. You can go to Facebook and follow Tax Talk for You as well. Also, go to W4CY.com, W4CY Radio, and you can be at every one of these shows as well, and some other great programs that we have on W4CY.com radio. We'll see you next week right back here, 10 a.m. Eastern Time on Tax Talk for You. Again, it's Tax Talk, number 4, letter U.com. Be here. We'll see you next week. Have a God bless, glorious, and awesome week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalkforyou.com. See you next week at W4CY.com.